What is going on, traders? Bearish bets against the market are going up in sky high numbers. We will go over the record number of shorts that we are seeing in the market currently, what that means for the market. I will give you a market update, an update obviously on all of the geopolitical affairs, what I think the market is likely to do based on trends, how close are we to a bottom. We'll take a look at an array of indicators because at the end of the day, I just want to make sure that you guys are good and that you have some data to back up some of the actions that you might be taking or might not be taking. As usual, everything will be split up into chapters below, so feel free to forward and rewind as you like. Let us get right into it. Back from Colombia with a power video today for you guys. So bearish bets against the market are surging. If we take a look at from the S3 data, S3 is a research company, you'll see that short sellers added almost $9 billion to their positions against the SPY or the S&P 500 ETF. Now, because of the type of environment that we are in, mainly, we know that Fed tightening is coming up, meaning rates are going to rise, which is bad for growth stocks in the short term. And the fact that inflation is still a high risk, we are seeing short sellers also taking out positions against growth stocks like Tesla and Nvidia that have seen insane valuations during 2020 and 2021. We are also seeing a high number of shorts on the bond market, which usually bonds tend to go up when stocks decline and vice versa. But because this is a very unique time period in which the stock market was actually roaring along with the economy and monetary policy was very dovish, now that stocks have hit astronomical valuations and inflation is just tearing a hole in the economy, the Fed is now forced to tighten policy as stocks are declining as well. And again, tightening policy involves raising the interest rates, which means that bonds will go down as well because there's an inverse relationship between bond yields and bond prices. Now, if you're a fan of this channel, you know that we've been opening hedges for months leading up to FOMC meetings because the market was forming sort of these short-term bearish formations at the top because inflation was surging as well. We've actually kept up hedges for a while. We just had a SPY hedge where we opened up a credit call spread on the SPY, closed that for 100% last Friday. Also had an iron condor on Tesla, which expired for 100% as well. This is technically not a short, but basically a neutral position. And we also send out the options day trade watch list every single morning, telling you what puts I'm buying if certain levels are broken. The Qs easily went below 338. The SPY easily went below 430 today. Opened up puts on both of those. On the Qs, we made 54% as well. Now, the reason I'm showing you this is to show you that the hedge funds don't have all the power here, right? I know that a lot of people who aren't really familiar with options or futures trading tend to deride shorting. However, shorting, as long as the retail investor is able to do it as well, and we are able to write short options contracts just as any institutional investor would. We're able to take any side of the market. So I'm of the belief, probably unpopular for the majority of people who create YouTube videos who aren't familiar with derivatives. You know, I'm of the belief that as long as we're able to do it too, meaning the retail investor is able to do it too, then it's all fair game. Why wouldn't I want to be able to hedge my portfolio in case there are economic downturns, especially if I'm in high conviction stocks that I plan to hold for the very long term, but I also want some relief in the short term. And if you want to learn how to trade options, you want access to our day trade watch list, you want access to all of the live alerts, stocks, crypto, options, long-term, short-term, hedges, futures, etc. Link is in the description below. Come be a part of the community. Would love to have you. So a record number of shorts is piling up. Is that the whole story? What is the market going to do in the short term? Are we close to a bottom? The shorts alone is not going to tell us. So let's take a look at the next catalyst, which is the geopolitical issues, because that is in the spotlight right now. Now, as I've said before, war is usually good for the stock market, unfortunately. And I say unfortunately because, again, I don't want war to be the reason that we celebrate gains in our portfolios. However, war during a time of inflation can be a deadly combo because, especially if it involves countries that have a heavy hand in commodities such as oil or metals like Russia does. So if we get a spike in energy prices, a spike in oil prices, a spike in commodities, that could cause havoc, especially with the European market, because Russia is not a direct trade partner of the United States, but they are a direct trade partner of Europe. And the US is a direct trade partner of Europe, right? So if there's already an energy crisis that is really deteriorating the European economy, If this situation gets worse and we see energy prices go up even more, then Europe could see a near recession or a possible recession, which would not be good for the global market, would not be good for the US either. Now, Goldman Sachs sees that the Nasdaq can drop almost an additional 10%, and the S&P 500 can drop an additional 6% if we see energy prices spike and if we see oil prices spike. Currently, oil is trading at around $91 a barrel. I think there's a consensus that we could easily hit the $100 mark. And if we hit the $100 mark, that is a psychological level that could further cripple the stock market indices. I posted this on Twitter from a user whose name is Alvaro Oviedo. I don't know who that guy is, so I'm not endorsing him, but I did like the chart. So if you look at the last few invasions that we've had, they've been buying opportunities. But the one invasion that really ended up with the stock market lower directly thereafter, even though we obviously ended up higher a year or two later, was in Afghanistan in 2001. Now, that is because we were reeling from a high inflationary environment in the year 2000. We were coming off of the dot-com bubble, and the CPI data hit 3.4% when the previous year inflation was measured at 2.7%. So we saw a significant increase in inflation, nowhere near the 7.5 that we are now. But obviously, this is relative to 22 years ago now. So the point being that this time, this conflict might be different because we are in a high inflationary environment where supply chains are constricted and energy prices are already high. So if we do see that $100 mark on the barrel of oil, then that could really spur a recession in Europe, which could bring about a near bear market or a bear market in the US. I mean, the NASDAQ is already near a bear market here. Remember, a bear market is defined as a drop of 20% or more from highs. We're almost at 19%. So we might as well be in a bear market in the NASDAQ. There is support at around 13,000 on the NASDAQ. So I will be looking at that level. We also see a head and shoulders here, which will probably and most likely play out, which would take us to a bear market on the NASDAQ. Remember that we haven't seen a rise in interest rate yet, which will affect growth stocks even more. The S&P 500 is in official correction territory. And if we break this level here, we are near support at 420, which if you looked at my previous videos, that was the major level of support we were looking at. If we break that, then I think we could be headed to the psychological level of 400, which still wouldn't put us in a bear market, but we would be at around a 16% drop at that point. And don't worry, I'm going to tie this all up in a summary, and you will see the summary pointed in the chapters below. I know I'm going through a lot of data right now, but it is all relevant. The 10-year Treasury yield is hovering here at around 2 and just shy of 2. This is actually what you want to see. As I said in my previous videos, we want to see the 10-year yield stick around here and hover around here. We don't want to see it go well past 2 because that will wreak havoc on the market in the short term. So as long as it remains around 2 and slightly below, then I'm okay here with what the market is doing in the short term, meaning I don't see a drastic situation beyond what I just described. Now, the last major thing I'll talk about is obviously the Fed meeting that is slated for March 16th. Now, before that, we get the CPI print on March 10th, which is going to inform a lot of what is discussed at the Fed meeting, obviously. We are now seeing a possibility of a 50 to 75 basis point rate hike at 32.7. This was as high as over 60% just a week or two ago. So majorly down from that, but still, a third of the Fed members believe that we will see a 50 to 75 basis point hike by March 16th. Now, we did see a very similar pattern back in 2018, 2019, when the Fed went through its last rate hike cycle, and in 2018 actually went further and started letting assets roll off the balance sheet like they're expecting to do in 2022. We saw this almost exact same head and shoulders that we are seeing now in the S&P 500. There was a relief bounce going into the FOMC meeting of March during that time in 2019. And then we saw a further drop after the Fed meeting due to what was said with regards to the balance sheet, with regards to rates, etc. So with that said, here is a summary of my take in the short term. I think the markets still have some more to drop. However, I don't think that the drop will be as severe as people think. Watch out for oil prices at $100 a barrel. Watch for gold hitting almost 2,100 an ounce. Those will be indicators that there will likely be more of a downturn in the short term. Volatility was always expected until we got the next CPI print, which was March 10th. Looking to see if we can see a decline in inflation. If we start seeing a decline in inflation, then I think the market will start feeling better about the Fed's chances to actually fight inflation. If we see another increase beyond what was expected in the CPI data, then we can also expect that to fuel the markets to continue going down further. Again, we saw this back in 2019, where right after the FOMC meeting, we did see another drop. So watch out for that. The inflation situation now is much worse than it was in 2019. As I said before, as long as the VIX remains above 20, I think there will be a ton of volatility and very little relief for stocks. Now, this does not mean that I'm not bullish in the long term. As you know, I'm very bullish in the long term. Buying corrections and bear markets has always been healthy for your portfolio. Obviously, depending on your time horizon, if you're someone that's looking to retire in a couple years, you might not have the luxury of time. And if you had pulled out your money when Meet Kevin did, then I don't think anybody would begrudge you, right? But I would only pay attention to high quality stocks here, stocks that have a muted PE ratio, meaning that they are undervalued compared to their peers in the S&P 500, and stocks that also manage their cash flows well, that have a positive forward free cash flow yield. It would help if those stocks actually paid a healthy dividend as well to help beat inflation. But this is not the time to go all in on high beta stocks. A lot of folks didn't think that these high beta stocks could fall further than where they were, and they just kept dropping and dropping and dropping because their valuations were too high. Use this as an opportunity to learn. Market downturns are a great chance, a great opportunity for you guys to slow down, get your charting up to par, get your valuation analysis up to par, learn how to evaluate companies instead of just buying tickers that someone says on YouTube without even taking a look at what the company does from a balance sheet perspective, from a free cash flow perspective, from a price earnings perspective. How many times sales is it trading? How many times of its book value is it trading? Start shaping up your portfolio to look a little bit more high quality than it is currently. And obviously, if you want to, take the time to learn how to hedge using derivatives such as options and futures. And again, if you guys want to learn how to do this, come join the community. It's a great value. Come be a part of over 4,000 traders chatting all day, every day about this stuff, where people are asking each other questions 24 hours a day, literally. We also hired a new coach on board who was a former financial analyst at Payne Weber, and she answers beginners' questions all day, every day. We are also going to start implementing coaching calls with her so that she can teach beginners how to evaluate companies, how to trade options, etc. Anyway, traders, that is it for this video. Hope you got something out of it. Hope it was helpful. If you got anything out of it, leave it a big fat thumbs up. Leave it in the comment section below. Let me know what you think the stock market is going to do. If you have any questions for me, leave it in the comments as well. I try to answer each and every one of them. I appreciate you guys. Stay safe out there, traders. Peace.